Over the past week, we see that semiconductors have had quite the wild ride. We're looking at the SOXX ETF that invests in semiconductor stocks, and we can see that over the past week, we're down about 3.2%. Now, the market's still open, so if you notice some of these prices and some of these intrinsic values changing, you'll know why. So the past week has been a bumpy ride up and down. Past month in the semiconductor space are down basically the same, about 3.4%. The past 3 months has been a little bit better. You're up 9.15% amongst all the major semiconductor companies in that space. Past 6 months, half a year, you are doing very well, 36.7%. And in the past 5 years, semiconductors have done quite well at 156% gains. So the question is, where are the opportunities in this space? Where are the opportunities? What are the good companies so that we can not only match the market, not only match this ETF, but actually beat them both? So we're going to look at the growth scores and the performance of companies in the chips, semiconductors, and memory space. We're also going to look at their safety scores, and we're going to emphasize right off the bat that we're going to emphasize growth over safety when we look at intrinsic values and when we look at the interflame finance weighting of these companies and the scoring that we do on this channel. But we're going to look at their intrinsic values, and then we're going to look at how we might invest a hypothetical $1,000 into these companies. Now, first up in the growth category, we have applied materials. Now, applied materials, they have pretty decent numbers across the board. We'll go through those in a bit. But if you have seen this channel before, you know that we highlight the best companies in boldface type when we compare across all companies, and we don't see any boldface type in these numbers. PEG ratio at 1.6, that's okay. We like that to be under 2. We really like that to be under 1, so we're not quite there yet. Forward PE coming in at an okay 27.2, debt to equity at 0.3, return on equity and invested capital in the low to upper 30s, that's good. Profit margins at 28%, pretty decent. Free cash flow yield at 23.3%. We like that over 7, so that's not even halfway there. But we have okay revenue growth and EPS growth. So pretty decent company when you look at it in isolation. But let's look at what else we have on the agenda today. We have Broadcom, AVGO. Much better PEG ratio coming in at 0.5, profit margin at 37%, revenue growth and EPS growth at 30 and 43% respectively. That's phenomenal. Free cash flow yield could be better. It's only at a 1.8, but their 5-year forward PE, if they can execute on this phenomenal growth, will be at an 11.6 in 5 years. So you're getting it today at an 11.6 multiple of expected earnings over the next 5 years. Now, debt to equity coming in at 0.8. We like that under 1, but we really like that under 0.7. So that is getting a little up there for our tastes. Next up is Lam Research, return on equity and invested capital, great at the 60 to 66% mark. Profit margins at a healthy 30%. Free cash flow yield is 2.3%. This is coming in at least boldface type higher than applied materials, and I'm guessing that's just because of rounding errors. But revenue growth and EPS growth in the mid-teens to mid-20s, that's decent. And a 5-year forward PE coming in at 15.8. That's the highest of the 3 so far. And now Micron, you can really see why this is the featured company of today's video. PEG ratio at 0.1, it does not get much better than that. This is what attracted us to Micron a year ago, is they had a PEG ratio well under 0.5, well under 0.2. Their PEG ratio has been consistently in like the 0.1 to 0.2 range. So just a phenomenal growth company in that regard. You look at their 5-year forward PE at a 4.8. I mean, you're getting it, today's prices, you're getting it at a 4.8 multiple of 5-year earnings. And you look at those earnings, you expect their earnings to grow 52.1% every year for the next 5 years. I will point out that when we do EPS growth estimates in our intrinsic value calculations, we're not going to use anything near 52%, just to make sure we are cautious and conservative in our estimates. But you look across the board, their debt to equity is very low at 0.2. They have great returns on equity and invested capital, profit margins above 28%. So this is just a solid company, and we'll look at what their growth score comes out to in a bit. And of course, you can't talk about any of these companies without talking about NVIDIA. And you see why we always feature NVIDIA in these videos. We see the PEG ratio at 0.5. We see the forward PE at 19.8. Their 5-year forward PE coming in at a 10.2. For such a solid, stable, gigantic growth company like NVIDIA, that is just great to see, a 10.2, almost in the single digits. Profit margins, the best of all these companies at a 55.6. Return on equity and return on invested capital, the best of all these companies. And the debt to equity, the best at just a 0.1. They have no debt on the books. We have a lot of conviction and confidence that NVIDIA can weather any storm and will grow in those storms. Next up is Western Digital. Now they have the highest free cash flow yield, just at a 2.5%. Forward PE at a 4.9, almost tied with MU at 4.8. And that's if they can execute on what's to be expected, a 41% EPS growth every year for the next 5 years. Revenue growth at 16%, that's pretty decent. Their debt to equity right on that cusp of what we like. They're at a 0.7. We'd like that to be 0.7 or lower. And the PEG ratio at 0.5. Great growth company in Western Digital. And finally, Texas Instruments, very similar to Applied Materials in numbers, but also in terms of just, we don't really see anything standing out in these numbers. When you compare Texas Instruments to the other companies, you don't really see anything that stands out, nothing in the higher one or two rankings. So now we're going to rank and score these companies from -10 to +10, where -10 is absolute garbage and +10 is the greatest company in the world. And we're not going to look at anything below 5 today. We've removed those companies. Just to let you know, AMD, KLAC, and QCOM, which is Qualcomm, we've eliminated those 3 companies. We did analysis on them, but their scores came in below 5 overall. And so we've just decided to not waste your time with those and just look at these 7 companies. So Texas Instrument, the lowest company coming in at a 5 today. And Applied Materials, no surprise, since their numbers are so similar to Texas Instruments, they're coming in almost tied with Texas with a 6. Lam Research coming in with a solid 7. Broadcom tied with Lam Research at a 7 as well. Western Digital at a 7.5. Micron at an 8.5. And the top of the leaderboard for growth scores is no surprise, once again, NVIDIA. Now, as we go through their safety scores, we're also going to look at the performance of these companies. So we have Applied Materials. They do offer a dividend at 0.5% dividend yield. They have grown their dividends about 15% in recent years, and they've grown those dividends for 8 consecutive years. So that is nice when it comes to safety. We like companies that can pay us a little bit of cash flow at least, get us a little bit of passive income in our accounts, in our portfolios. And their PE ratio currently one of the best at 36.1. Now, Applied Materials has not had the best week. They're down about 6.3% in that time. Over the past month, you're up about 5.5%. The past 3 months, fantastic, 30.5% growth. And in the past year, Applied Materials is up 124%. So we see this as a solid company. Their stock price is reflecting that. And of course, just a reminder that past performance is not an indicator of future growth. And so just because the past year has seen a 124% growth in stock price does not mean they're going to continue that. We will look at intrinsic values in a bit. Now, next up is Broadcom. Broadcom has grown their dividends for 16 consecutive years, and they are offering you a 0.8% dividend yield on your investment. The payout ratio is 50%, so that's getting a little bit high, but no reason to suspect they're going to have to cut those anytime soon. Their PE ratio is quite lofty at 68, so we don't like to see that. And return on assets, not one of the best at a 12.8%. Now, Broadcom is sort of bucking the trend of these other companies. Over the past week, they're up 7.2%. Over the past month, they're basically even at 0.7% down. Past 3 months, they are actually down 16%. So that's quite intriguing. Is this just a short-term dip, or is this something more significant with this company? We'll see that in a bit. Over the past half a year, you are up about 1.4%. Over the past year, you are up 75%. And over the past 5 years in Broadcom, you are up 670%. So huge growth company. They have grown quite a bit. We do see in their stock chart, they seem to be leveling out quite a bit. Is this just taking a quick breath, or are we seeing some actual weakness in the stock price, or is it about to pump once again? Lam Research, also a very small dividend payer at 0.5%. They have grown their dividends 12 consecutive years, and in recent years, about a 13.5% growth in that dividend, 26% return on assets. PE ratio, a little bit high at 45, but 5-year forward PE coming in at a 15.8. So the past week, Lam Research is basically following the trend of the other semiconductor companies. We're down about 6.2%. Over the past month, we're down about 5.5%. In 3 months, had you made an investment, you were up 30.66% in Lam Research. Over the past 6 months, up a 105%. So you've more than doubled your money in 6 months' time. Over the past year, you are up 174%. And over the past 5 years, just a phenomenal, almost 300% growth. That means you've basically 4x your money if you invested in Lam Research 4 years ago and you just held. Now, Micron does offer a very tiny dividend at 0.1%. We don't have any growth or years of dividend growth data, but that debt to equity at 0.2, that 5-year forward PE at 4.8, the super low payout ratio of 5.2 doesn't suggest that we're going to cut these dividends anytime soon. And pretty decent PE ratio for such a solid growth company coming in at 39. So in the past week, Micron is down about 1.3%. Over the past month, we are up 6.3% on that position. Over the past 3 months, Micron is up about 62%. Over the past half of a year, you have tripled your money in Micron. Over the past year, up 338%. And then the past 5 years, not a lot different than the 1 year mark, mainly because most of that growth has happened in the past year or so. Now, NVIDIA does pay a dividend. It is super duper tiny, so tiny, in fact, that it doesn't even register when we round to one decimal place, but they've technically grown their dividends for 2 consecutive years. We could not find reliable dividend growth metrics, mainly because it's so tiny that it's quite relative to that starting price. Payout ratio, basically nothing. Debt to equity, also basically nothing at 0.1. And we see the best return on assets at 63%. Now we're up in NVIDIA 1.3% in the past week. In the past month, we're actually down 2.67%. In half a year's time, we are only up 8.3%. So we know NVIDIA has grown, and they may have done most of their growing in the past 4 or 5 years or so, because in the past half of a year, so many other companies are up double digits, even triple digits. NVIDIA is only up about 8.25. Over the past year, you have more than beaten the market at an even 64%. And over the past 5 years, we are up 1,376% in NVIDIA. So there's a reason why this is the largest company in the world, and there's a reason why this is one of the best performing companies over the past 5 years. They have done phenomenal on their balance sheets, their income statements, and that is reflected in their stock price. Now, Texas Instruments, they have grown their dividends 22 consecutive years, recent years about 4.5%. Their payout ratio gives us a little bit of reason for caution at a 102%. That means they're pumping a lot of their money into their dividend, which is the highest of all these companies, almost at 3%. So you're getting a pretty decent dividend yield for such a well-established technology company. However, the question is, it comes at what cost, right? I mean, if we cannot put our profits into investment, research, and development, then why are we paying this 3%? So there is a risk for the dividend to be cut or possibly even eliminated for Texas Instruments. Their debt to equity is getting up there, and not the best return on invested capitals or assets for this company. Had you invested in Texas Instruments a week ago, you're down about 5.6%. In the past month, you're down about 9.5%. Texas Instruments is up 10.3% in the past 3 months. Over the past half of a year, you're up about 7%. Over the past year, you're only up 4%. So think of all the other companies you could have invested in the past year that would have gone up double, triple digits. Texas Instruments only up about 3.9%. And then over the past 5 years, I mean, basically even, very much underperforming the market. In the past 5 years, the market's gone up quite a bit. Texas Instrument only up 16.3%. And finally, Western Digital. Now, they do offer a very tiny dividend at 0.2%, but we see that their payout ratio is only 3.3%. So probably not going to cut those anytime soon. But you just look at the valuation of this company with a PE ratio of 27.6 and a 5-year forward PE at 5.1. It just looks like a steal deal, at least on the multiples metric valuation. Look at their debt to equity, straddling that 0.7 mark. We would like that to be lower. Now, this is a company that is basically flat over the past week. Over the past month, you're down about 5.8%. Over the past 3 months, you're actually up a very impressive 59%. Over the past 6 months, you have almost tripled your money at a 184.8% growth. In the past year, Western Digital has just completely dominated at a 545% increase in that time. And then over the past 5 years, it was flat for quite some time. And it's only been since over the past year that we've seen most of that growth. So over the past 5 years, you're up 288%. And most of the time, you've just been waiting patiently for the stock price to increase. So Broadcom comes in dead last when it comes to safety at 2.1. On this channel, we typically like scores of 5 or higher. What we will do is we will average them with their growth and see how they score in the end. But Broadcom, as far as safety goes, with that very high valuation and relatively high debt to equity, we don't like to see that. So we're saying that they are coming in just at a 2.1 when it comes to safety. Now, Lam Research also toward the bottom, also under a 5, coming in at a 3.6 on our scale. Western Digital at a 4.3. And a lot of that is because of their very low dividend yield. And they don't have any growth or years of dividend growth on the books that we could find reliable information for. So we're putting them at a 4.3 for safety. When it comes to Micron, also 4.3. Great company, awesome growth, but we see very small dividend. And just like Western Digital, we don't see any reliable growth data out there. Applied Materials is our first company to score at a 5 or higher for safety. And Texas Instruments tying with Applied Materials also at a 5. And NVDA, a three-way tie for first, also at a 5 for safety. So we know that these are all solid growth companies. It's not just enough to know that you have good companies. You want to make sure that you buy them at good prices. And so what we're going to do now is compute the intrinsic value of all of these companies. And so we have the PE ratios model. We have the dividend discount model. We're actually not going to use this for any of these companies because they are not solid, large dividend paying companies. We're going to look at the discounted cash flow model, and we're going to look at the new one on this channel, the Graham valuation model. All four models are linked in the description below. So you can watch those videos and you can build out these spreadsheets and Google Sheets yourselves. So you can do these for these companies if you disagree with our numbers, or you can do them for any companies you want to make sure that you're buying these companies or any companies that you invest in at good prices. Now, before we get into the intrinsic values and the scores of these companies, if you're getting anything out of this video, please consider liking the video. That really helps out the channel, and consider subscribing so you can keep coming back for more scoring and intrinsic value of some of the best companies in the world. So the lowest scoring company is Texas Instruments, coming in at an average score of 5. You'll notice that we are emphasizing growth over safety. So we're giving growth a weight of 80% and we're giving safety a weight of 20%. Yes, we do want safety. We do value safety, but we really want to make sure that we are looking at the growth scores and we're weighting them more heavily because these are all solid growth companies. So the average score for Texas Instruments is coming in at a 5. The intrinsic value, we think this company should be trading for $150 per share. The price is currently $198. That means that you're paying a 32% premium for Texas Instruments if you want to buy it. We are not too terribly interested in paying too much for companies, so it's probably something that we're going to skip. Applied Materials coming in next at an average score of 5.8. Their current stock price is $349 per share, and we think that the intrinsic value of this company is $290. That means that for Applied Materials, you are paying a 20% premium. Broadcom coming in just over 6. That's nice. Intrinsic value is $415. Current stock price is $341. So if you were to buy Broadcom right now, you're probably getting it for something like an 18% margin of safety. That means that the current stock price is lower than what it's truly worth. And so that is something that we might consider buying. Lam Research with a slightly higher average score at a 6.32. However, their intrinsic value is $190 per share and the current stock price is $217. So you're paying about a 14% margin of safety for Lam Research. Now, Western Digital is looking pretty attractive at about a 6.86 on the average Interflame Finance score. The intrinsic value is $421. The current stock price is $270. That gives us a margin of safety of 36%. So we typically like margins of safety in the 15 to 20% range at a minimum. So Western Digital with a 36% margin of safety is something that we're probably going to be interested in the Interflame Finance portfolios. And no surprise, when it comes to Micron, average score of 7.66, intrinsic value is 614, currently trading for 405. That gives us a 34% margin of safety when it comes to investing in Micron. Still, after all this time, after the past year of just phenomenal doubling, tripling, and quadrupling our investments in this company, it's still coming in as a steal deal. Micron Technologies, 34% margin of safety. Great numbers. And once again, NVIDIA at the top of the leaderboard, 8.2 average score. They're currently trading for 184. We think that they should be trading for something closer to 305. That means that they are trading at a 40% margin of safety based on their current stock price. So how would we invest a hypothetical $1,000? This would be a great place to remind you that nothing that we say on this channel is financial advice. We are not telling you to buy, hold, or sell any of these companies or any companies at all in your personal portfolio. Always do your own research and your own due diligence before making investments in your portfolios. Now, Texas Instruments, for a lot of reasons, is something that we're not interested in buying right now. If we were to invest $1,000 into these 7 companies, we would put nothing into Texas Instruments. They're trading at a premium. We would consider maybe buying at $128 per share. It's currently trading at $198, so that's quite a drop in the stock price. And we would buy much more heavily if it ever got to a 35% discount. That would be $98 per share. Same goes for Applied Materials. 20% premium on this company. We would invest $0 of our $1,000 into this company. We might consider buying Applied at 247. That would give us a 15% discount, and a 35% discount, we would buy much more heavily at 189. Now, at a current stock price of 349, that is quite a drop, so we'd probably be waiting for quite some time to make an investment into Applied Materials. Broadcom is the first company that we might consider buying. Of our $1,000, we would put about 11.4% or $114 into that company. They are a buy. They are under a 15% discount because they're trading at a margin of safety of 18%. If it got 35% or even more of a discount. Lam Research, also something we're not interested in buying today. We would put $0 into that of our $1,000. They're trading at a 14% premium. We would consider buying at 162, and we would buy much more heavily at 124. Now, Western Digital is quite appealing to us. Their score was about a 6.9, margin of safety 36%. We would put 26.4% of our money, or $264 of our $1,000 into Western Digital. They are at the buy and the buy heavy mark as far as our intrinsic values are concerned. And so this is a company that we've never actually purchased. We've never actually held Western Digital, but something quite appealing based on the numbers that we're seeing here. And now MU, Micron Technologies, is still a buy. We would put 27.6% or $276 of our $1,000 into that company. We would buy because they are at 522 or lower. As a matter of fact, their current stock price is 407. It's getting very, very close to that buy heavy mark at 399. And NVDA gets the rest of our money. It gets 34.4% of our money based on their very high average score, based on the fact that they have the highest margin of safety at 40%. Their current stock price at 184, intrinsically worth 305. They are at the buy and buy heavy mark, well under those. So there you have it, folks. 7 companies, 7 quality companies that are in the chip, semiconductor, and memory space. Of these 7, we would put money into 4 of them. And again, nothing that we say on this channel is financial advice, so we're not telling you to do this, but this is how we do our investments here at Interflame Finance, and we've done quite well. If you subscribe to this channel, there are videos upcoming to show you how we are doing in the Interflame Finance portfolios, and based on our stock predictions that we made at the start of 2026. And spoiler alert, we're actually not only beating the market, we are completely destroying the market. We have some fantastic companies that we invested in back in 2026, and those companies, by and large, are doing quite well relative to the rest of the stock market. So I appreciate you being here. Thank you very much for watching this video. Please like if you got anything out of it. It would really help out the channel. Please consider subscribing so you can keep coming back for more content. Tell your friends, tell your family, tell your mother-in-law about Interflame Finance. We appreciate you being here, and we'll see you in the next video.